Okay.
All right, welcome everyone to this afternoon's free trading webinar with Option Hotline. We are happy you are all here. You are looking at a brief disclaimer, so go ahead and read through that before we get started with today's special guest. We are hosting Chuck Hughes and Guy Adami to discuss their 2021 stock market outlook and have some live Q&A between you all. First, I just want to introduce your moderator for today's webinar, Steve Fox with the team at Option Hotline. Steve's going to introduce himself and then give a little brief intro about Chuck and Guy, and we'll get the ball rolling. Over to you, Steve.
Thank you, Natalie. Yes, we are extremely pleased to offer you a very special webinar today. We have two outstanding commentators to give you the webinar. Chuck Hughes is one of our own. Quick bio on Chuck. After graduating from college, Chuck entered the U.S. Air Force Pilot Training Program. He served 6 years on active duty and 6 years in the Air Force Reserves. When he completed his active tour of duty, he got his dream job as an airline pilot for a major U.S. airline. Trading fit in well with Chuck's airline pilot, because he could trade on his days off. And he liked system trading and developed his own trend following system that he still uses today. With this powerful trading system, Chuck has become the only trader to win the stock trading championships 10 times. He's written numerous books on investing and taught thousands of people how to make money trading. Chuck resides on the central coast of California with his wife and 6 children, and now trades full time. He's an avid tennis player and enjoys hiking in the mountains of Big Sur. We should all be so lucky. Chuck is also joined, we are also joined, very thrilled to have Guy Adami. Many of you have seen him on television. Guy is one of the panelists from CNBC's Fast Money, and you can see him most days on Fast Money. And Guy, as you begin, I will let you talk a little bit more about yourself, but we're extremely pleased to have you here. And we're extremely pleased to have both Chuck and Guy. And unless I've forgotten something, Natalie, I will let Chuck take it away.
You're good, Steve. Just go ahead and stop sharing your screen, and we'll have Chuck and Guy take center stage so we can admire their beautiful faces as they dazzle us with their market talk. There they are.
All right.
Well, I want to say thank you, Natalie. Thank you, Steve. And, you know, you mentioned you have 2 great people. You have one. You got Chuck Hughes, and then you got me. I'm a bit of a hack, but it's an honor to be with you here, Chuck. And, you know, I'm not going to talk about myself. People aren't here to listen to that. But what I will talk about is the fact that 2 minutes ago, the market, or 3 minutes ago, the market closed at another all-time high. It's remarkable. So this is about 2021 outlook. I'll ask you, Chuck, you know, what are your thoughts here? A new administration was sworn in today, markets at all-time highs, pretty much across the board. You know, what are you thinking as we head into this year in earnest now?
Yeah, you know, Guy, I've been trading stocks for more than 35 years, and the way the market has been handling the news has been uncanny. I mean, I've never seen anything like it. We had rioting, insurrection in the Capitol building, but 2 days later, the S&P hit an all-time high. We had a Democratic sweep of the White House and Congress, which normally would be viewed as negative because of rising taxes and regulations. Don't forget the massive Russian cyber attack on the White House, all 5 branches of the military, the NSA, and over 400 of the 500 Fortune 500 companies. And we've had a slow rollout of the vaccine. So despite all this news, the S&P just keeps marching to new highs. So it must be the, you know, the massive stimulus package and the Fed's policy of low interest rates until 2023 that's propping up this stock market. What's your take, Guy?
No, I appreciate that, Chuck. And thank you. I'd be remiss if I didn't say thank you for your many years of service. I think I echo that on behalf of all the participants. And I want to say, I should have said at the top, I want to thank everybody for joining us. I think we're well over 100 people now, so thank you for spending your time. Your time is as valuable as anybody else's, and we really appreciate you joining us. I think I speak on behalf of Chuck and the Option Hotline team. With that said, my take is, I look at the landscape. I look at right now the S&P 500 trading at a forward multiple close now to 24 times, which is extended to say the least. I see an S&P 500 market cap of about 190% or so of U.S. GDP. And oh, by the way, that numerator continues to go up, and that denominator, well, it doesn't seem to want to go up anytime soon. And maybe it's actually going the other way, which makes that ratio even more interesting. And that's the one thing, by the way, folks, the one indicator that Warren Buffett looks at amongst many. And I think that's the most important one he looks at. In his world, anything north of 120% is expensive. And here we are at 190%. I look at the city panic euphoria index at levels we probably haven't seen maybe ever. That's somewhat worrisome. So one of these in a vacuum is not all that interesting, but when you layer on 10, 15 of these that are all seemingly flashing red, it's concerning, Chuck. But to your point, does it even matter? I mean, Jerome Powell spoke about this a couple of weeks ago, and he testified or made some comments basically saying in this interest rate environments, valuations don't matter. My pushback would be valuations always matter, Chuck, but I'd like to hear your thoughts on that.
Yeah. The in FactSet in their latest report said that the forward 12-month PE on the S&P 500 is 22.6. Now that's the most expensive in the last 10 years. So the market is very expensive here. And can it keep marching up to new highs? I would have to say yes. Is it overbought? It's way overbought right here. So, I mean, we could expect a 5-10% correction at any moment. And usually it's when you least expect it, and the market just tanks, and you're sitting on long positions. So just keep that in mind. We're getting very long in the tooth, both in the economic expansion as well as the expansion of the PE, but the market could keep going up from here. To me, what's interesting is Australia has not seen a recession since 1991. So even though the U.S. economy has been expanding for 11 years, it could keep going for years to come.
That's a great point, Chuck. And again, I want to encourage folks to ask questions in the chat room or the Q&A. If you see me leaning forward, so I can look at the questions and try to answer them in real time. So fire away with your questions. That's why we're here. But you're right about that, Australia, and you're right about our, 12 years effectively of just the market, with, the exception, obviously, of March, April, or January, February, March of last year, when we saw a 35% move in a record amount of time. I mean, this thing has been on autopilot. But my question to you, Chuck, and I have a view on this that I'll share if you're interested, but a question I asked Danielle DiMartino Booth today on a conference I was hosting, and I'm going to ask it to you. Are recessions a bad thing? And that's my question.
Yeah, that's a great point. And, when you get a severe recession, then obviously you're going to get a bear market, and always have. So, but a slight recession, 2 or 3%, there's still going to be sectors in there that are expanding and companies that are growing their earnings. So if you can become a stock picker in a recession and still do good.
Yeah, and I asked that question, Chuck, because I think, and I'm guilty of this in so much that you associate me with the media. I try to avoid this because I don't like using adjectives when I talk about the market. It was a good day because the market was up. It was a bad day because the market was down. I think when we do that, we're doing a disservice to the audience. But I'm one of these people that believes recessions are a good thing. And not only are a good thing, they're a vital thing in terms of the business cycle. And I think what's happened here, again, just my opinion, I'd be interested to hear what you think, Chuck, is that back in the Greenspan days, I think Mr. Greenspan realized that he could sort of alchemy out the recession portion of the cycle, of the business cycle. And my pushback would be, yeah, he was successful in that, but at what end? Because, again, my opinion, I think recessions are a normal, natural, and healthy part of the business cycle. Like in nature, when you have a forest fire where old trees burn down so new trees can grow, and that's how forests regenerate themselves. It's the same way in the business cycle. You have to allow some companies to sort of fall by the wayside in order to allow new companies to grow. And by quelling that or suppressing that, what winds up happening is you have a downturn that's going to be exponentially worse than it would have been. And we've seen that a number of times over the last 20 or so years. So I think the mistake that central banks are making is they're trying to alchemy out a natural and vital part of the cycle. Thoughts, Chuck?
Yes, yeah, I totally agree. And you know, the last two big bear markets, we're trend followers, and we simply follow the trend. So we still found sectors in 2008 and 2001, 2002 that we could trade, and so we simply followed the trend, and we did okay. The other thing we do is we're option traders. So when the S&P 500 drops below the 10-month simple moving average, we start looking at buying put options. So we did have short positions during the severe bear markets, and you know, and we wound up profiting those years. But the one thing about bear markets is you have to be really nimble, because they're usually pretty short, and you know, just about the time that you're loaded up with short positions,
Mm-hmm.
the market bottoms out. So to answer your question, we simply follow the price trends and that 10-month simple moving average, and we'll take long positions in the strong sectors and stocks. And then in a recession and bear market, we'll actually take short positions in the weakest sectors. And, you know, we've been able to survive and prosper during those bear markets.
Yeah, it's interesting. There's the old adage, I know you know this, Chuck, the market takes the stairs up and the elevator down, and those moves to the downside are quick, and usually it's very difficult to catch them, but we have seen them. And it's interesting, over the last month or so, twice now we've seen on a Monday, the VIX, which closed the prior Friday around 21.5, 22, on two separate occasions now, we've seen that spike up to 30 on generally benign market moves. And my question to you is, of those two moves, and I know you know of what I speak, are those two moves sort of a tell going forward? You know, my take on it, the VIX is sort of on a hair trigger right here, and any small amount of incremental news is going to trigger it. What's your sense in terms of those 2 days specifically, and what it means going forward?
Yeah, you know, the market is it's been very, very volatile. As a matter of fact, 2020 was the most volatile year in the stock market since 2008. So there's been a lot of sector rotation, a lot of headline news that is just creating a lot of volatility. So it's hard to follow. You know, you used to be able to follow the VIX, and it had a pretty predictable price pattern, and the result of the price pattern. But even the VIX has been up and down and all over the place. So a lot of sector rotation, a lot of cross currents, a lot of headline news, and we simply, you know, stick with our stocks that are in a price uptrend, making new highs. We stick to those, and you know, we've been able to get through those cross currents with the VIX.
Understood. And so one of the questions from D on one of the gentlemen, I think it's a gentleman that joined, is how do you hedge your long positions? Are there situations where you say to yourself, now's a good opportunity to hedge a long position? And if that's the case, how do you put on those hedges? I know it's different in each case, so I'm not trying to paint with a broad brush here, but
Yeah.
generally speaking, you know, how are you hedging your positions?
Yeah, that's a great question, and that's the focal point of our program here at Hughes Optioneering. Whenever we have a profit in a stock or an option, we always leg into a spread trade, and we do that two ways. We either buy a put option to protect profits, or we sell a call option. So we always leg into a spread whenever we have a 7 to 10% profit in a stock or a 30% profit in an option. We always leg into a spread because the next correction is just around the corner. And of course, the spreads have a long position and they have a short position. So that short position will profit as the stock goes down. So that's the main strategy that we focus on as traders is always hedging a profit in a stock or an option, because the next correction, is just around the corner, and that's
Yeah.
worked out really well for us.
No, and I think it speaks to a discipline in your trading. And my sense is that discipline is born from your years in the service, which, maybe I'm wrong, maybe I'm right, but my sense is, that's how you can separate yourself from the crowd. Because I think the mistake that a lot of us make, and I say us, is we get emotion sort of makes its way into our trading strategies. And, I play the game with people all the time. If I had told you you're going to buy GM at let's just say $34, just for sake of argument, and in a month it's going to be trading 53, would you sign up for that? And I think most people would say unabashedly 100%. Then it happens, and then people start doing this. Well, here's an opportunity for me to pay off my mortgage or put my kids through college or whatever that game is, and then you miss it. And then by not taking profits or taking some money off the table or putting on a hedging strategy, 53 on a Tuesday becomes 48 on the following Monday.
Yep.
And then you say to yourself, well, gee whiz, it was 53 a week ago. I can't sell it at 48. Now, instead of being proactive, you're trying to be reactive, and that never works. Does that make sense, Chuck?
That makes a lot of sense. And we've all been there as traders. Experienced traders have experienced that many times. The worst feeling is to have a profitable option portfolio or a profitable stock portfolio. And then out of the clear blue, there's bad news overseas. And all of a sudden, that profitable portfolio turns into a losing portfolio. I mean, that's hard on your psyche as a trader. So you don't want to get into that position. And the way we do that is we always hedge our profitable trades no matter what. And that's has saved us so many times when you have these really quick, sharp corrections. And if you didn't have the hedge on, then you just have to get out of the stock, after a 7 or 10% loss. You'd have to get out of the option at a 30% loss. Otherwise, you're looking at big losses, which are really hard to make up for. So we avoid all that by hedging our positions every time we have a profit in a directional trade.
I appreciate that. And I'm going to so I apologize. You see me leaning forward. It's because I'm trying to read the questions. I don't see as well as I used to. So that's why I'm doing this. So bear with me, Chuck. We have a question from Clinton. I agree with what you're saying regarding a pullback. But what's different this time is that all the cash is being printed and distributed. Where else can this money go but into some form of the economy? And I understand, and Chuck, I'm going to let you opine on this. And I understand that falls under something that I've never said on our show, and I'm reticent to say here, but there's this belief that, the TINA world where there is no alternative and this money finds its way into the stock market. That's been 100% true. But, at a certain point, Clinton, valuations matter. And I understand what you're saying in terms of all this liquidity, finding a home somewhere, but you've pushed a lot of risk assets out to the outer banks of their spectrum. And that's concerning to me. Now, it doesn't mean it can't continue. Chuck mentioned that earlier. I mean, these things can continue to move in one direction, and the market can stay irrational longer than you can stay solvent. That's the old trading adage. But you have to be aware of what's going on. So just understand that I think we're all sort of in the deep end of the pool in terms of valuations and what the Fed printing press has done. Chuck?
Yes, absolutely. I totally agree. And you want to prepare yourself for the next downturn, because you never know which one of these 5 or 10% downturns is going to develop into a bear market. So you just want to be prepared for that. I mean, you want to ride the wave while it's still good, but just be prepared to get out when the market starts trending down and doesn't recover on good news. And of course, the other thing you can do is hedge your position whenever you have a profit. So, but yeah, the market is so expensive, could have a quick decline at any moment, but just keep in mind that, you know, the trend right now is up and the market's making new highs, and we just, you just want to be careful and hedge your positions.
Yeah, and that sort of leads me into John Burke's question. Is there a hedge, Chuck? And this is not about making recommendations, but the word is there, so I'll use it. Is there a hedge you would recommend today for long portfolios, not based on individual stocks, but based on the risk of the overall market position?
Yes, if you had a portfolio of stocks, you could always purchase put options on the S&P 500 index. If you have a lot of tech stocks, of course, you could buy a cheap put option on the NASDAQ, and you can hedge your portfolio that way. And we do that in addition to buying hedges on individual positions. We'll also buy a few cheap puts on the whole portfolio, just in case. And you never know when that next correction's coming. So you want to be prepared before it comes.
Yeah, and you know what, Chuck, this is interesting because Clinton, I think, if I'm reading this correctly, you know, he was disciplined and he sold Netflix. I believe it's Netflix, Clinton, you can correct me if I'm wrong, last week, and it hurts today. Now, I understand exactly what you're saying. What you're saying is, gee whiz, I took money off the table too quickly, and obviously the stock is up huge today, and that's painful. Well, here's what I'll say to that. Despite what you may hear, read, or see on television, nobody sells the highs and nobody buys the lows. And that's boring Saturday night cocktail party conversations, at least when people are having cocktail parties. You know, the guys or the gals that told you how they sold the balls high in X stock or they bought the low in certain stock. If it's true, good for them. And if it's not true, they're just sort of wasting your time. So the only thing that matters, Clinton, is how your trading book looks. It doesn't really matter what people are saying to you or whether or not you sold the high or you bought the low of something. Chuck, I'm interested in your thoughts on that.
Yeah. Now, Netflix is a very volatile stock, and it has really rich option premium. So that's the type of stock. The way we hedge with that is to sell a call option, because you're going to get a really rich premium for that. So with stocks like Netflix and Amazon, Square, PayPal, they have rich premium. So if you own that stock, or if you own a call option on that stock, sell a call option against your position, because you're going to get a rich premium, and you could make out really well, even if the stock is flat. You know, over the holding period, you could still make a 20 or 30% return by selling a call option. So with those stocks, volatile stocks with rich time premiums, we'll sell a call on those to hedge the position, and you could make money even if the stock goes down. So that's right. That's how we hedge those volatile stocks.
And Chuck, the way I look at that is, you're talking about, number one, I think this is very important, and I think a lot of people understand this, but if folks don't, it's incumbent upon me to bring it up. You're talking about selling a call option against an existing long position, which is the prudent thing to do. You're also talking about a situation where, in your opinion, you're getting paid the proper amount of premium to do so. Every situation is different. Sometimes you're not getting paid enough to sell that call option, but in the case of Netflix, your thought is you were. But it's important to point out that what you're talking about is a hedging strategy, but also in that hedging strategy, it doesn't, although it creates that synthetic dividend for you, it doesn't obviously protect you from the potential downside. All it does is create a dividend. Am I saying that correctly, Chuck?
Yes, that's correct. And you can get, depending on the stock, like for Netflix, you could probably get a 4 or 5% premium every week on that if you sell a weekly call option. If you sell a monthly call option, you could probably get a 15% premium, that's 15% in relation to the stock price itself. So you could have a 15% return even if Netflix closes flat over that period. The only time you would lose money, of course, is if it went down more than 15%.
And it's interesting. I want to read another question. I think this is from Enrico. I apologize if I'm just trying to read. As a new trader, is it prudent to place stop limits on all my equities given the state of the market, or is it a better approach to buy longer duration puts? Okay, I'm going to take a stab at that, Chuck, and then I'm going to let you take a stab at it as well. So, is it prudent to place stop limits on all my equities given the state of the market? I don't think it has anything to do with the state of the market. I think you should always, Enrico, in my opinion, you should always know where your out is. I think the most important thing to do is before you even put on a trade to know where you're going to get out if you're wrong. So market state notwithstanding, I think the discipline is such that you should always know where you're going to get out if it goes against you, and then live to fight another day. Is it a better approach to buy longer duration puts? Well, that really all depends upon what you're paying for them, and the volatility the volatility embedded in those options. I think so. That's a case by case strategy. So, buying longer duration puts, problem with that is you can bleed away each day, and that's what obviously owning an option does to you, as opposed to knowing where you're going to get out in terms of a stop loss. Chuck, I throw that to you.
Yes. What we do is with less volatile stocks or less volatile ETFs or indexes, we'll simply buy an at-the-money put. And we usually pay, it's probably going to cost us for a month 2 or 3% of the value of the stock. So if you hedge a stock that's less volatile, you're in effect, you don't have to use a stop loss because you have that put in there. So let's say the emerging market ETF is trading at 40, and you buy a 1 month at the money put, and you pay maybe 80 cents for that put. You're fully protected. You don't have to worry about stop losses. And you would also participate if the emerging market index keeps going up. So the put protection for less volatile stocks and indexes is fairly cheap. And right from the beginning what your maximum risk is. You don't have to worry about stop losses or exiting in a big downturn, because you've already placed that protection, and your maximum loss is going to be 2 or 3% over a 1 month period.
Mm-hmm. Matthew asked, and I think we answered the question, but I'm just going to make sure. So can you give an example on how to hedge a position? And I think we just gave a couple of examples, Matthew. But each position is different. So each position brings with it a different set of circumstances. So you can't be there's no formula for this. I think each situation brings with it a different set of risks, and then that different set of risks brings with it a different set of options and hedging strategies. So I don't want to, again, I'm very reticent to paint with a broad brush. And then Richard asks, Chuck, with stop losses, and this goes back to my last comment, with stop losses, what is the rule of thumb on a percentage gain or percentage loss? And I'm going to let you answer first, Chuck, and then I'm going to take a shot.
Okay, yeah, that's a great question. We will exit a stock position whenever we have a 5 or 6% loss. If we're wrong and the stock goes down, we'll exit quickly, and we'll just move on to a better opportunity. With an option, because options are leveraged, you want to use about a 20 to 30% stop loss on options. So you give it some room to move without getting out too quickly. But once you get to a point where you have more than a 30% loss on an option, you definitely want to be out, because that could easily develop into a 100% loss, and then that's really hard to make up. So for stocks, we'll exit at a 5%, 6% loss. For options, about 20 to 30%.
I think that's a fair answer, Richard. Hopefully, you heard that. What I'll say is this again: there is no rule of thumb. I think every situation is different, but I think you have to know. Again, I'm going to hammer this home. I think it's more important to know where your out is if you're wrong than where your take profit levels are. The take profit side is, that's the high class problem. But the thing that gets most people in trouble, Richard, is that downside, because I will tell you, it's very hard for people to admit when you're wrong. And by definition, getting stopped out of a trade is an admission that you're wrong. But, I'll say this, and then I want to bring up another question. Mark Fisher, who in my world, I was a commodities trader for a long time. He's sort of, on top of Mount Rushmore. And what he will say when he speaks is he can be right 25, 30% of the time and still make money. Whereas a lot of the lay people that do this can be right 50% of the time and figure out how to lose money. And the one predominant reason, the only reason is Fish gets out when he's wrong and he lets his winners ride. And I know you've all heard that 1,000 times, but it's really important. So I guess my point is to everyone, the most important thing to do with any position is to know where you're out when you're wrong. And it's okay to be wrong 50, 60% of the time, as long as when you're right, you let those positions work for you. And now I'm going to ask you this. Dean asks, and again, I apologize for leaning forward. Dean asks, speaking of hedge and volatility, Chuck, do you always or sometimes recommend straddles?
By a straddle, I think you mean buying a stock and buying a put.
I don't want to speak for him, but my sense is that's correct. Yes.
Okay. Yes. The best way to hedge a stock position, especially a stock that's not really volatile. Like let's just take the EEM again, the emerging market index. That's not very volatile, but it's in a nice uptrend. So you could buy your hedge fairly cheaply on the EEM. Maybe 2% a month, 3% a month. So that's how I would hedge a less volatile stock. If it's a volatile stock, like we mentioned, Netflix, Square, Amazon, Nvidia, with those type of high beta stocks, we prefer to sell an at the money call option, collect some premium, which gives you downside protection. And you could, on a monthly basis, you could make a 10 to 15% return, even if the stock is flat. When you sell that at the money call, if the stock is flat, you're still going to have a 10 or 15% profit.
Yeah, and that obviously depends on the stock and the volatility. But what you're talking about, again, is something I said earlier, is you're creating a synthetic dividend for yourself vis-a-vis that option strategy. Understanding, by the way, and this is important, Chuck, I know you know this, but it's important to bring up that selling a call against an existing position doesn't protect you entirely on the downside. It just protects you to the amount of premium that you're collecting. I think that's really important for people to understand. I think there are people that think by selling a call, their risk to the downside has been mitigated or taken away entirely, and that's not the case. You've just created a synthetic dividend for yourself. So I want to get to another question. I think this is Vin. Chuck, how much safer are bull call spreads than just straight directional calls?
They're much safer, and over the last 12 years, our spread portfolio, where we buy a call and sell a call, that's been by far the best performing strategy that we have. So buying the call, selling the call, you create that downside protection, and you also can profit if the stock is up, down, or flat. Many times, even if the stock's down 10%. So overall, that's the best strategy we've seen over the last 10 to 12 years. A simple bull call spread. Now, that has a huge advantage over just a directional call option trade. You could be sitting on a very profitable portfolio of call options, and all of a sudden there's bad news overseas overnight, and within 1 or 2 days, that highly leveraged call option directional portfolio can really it can be wiped out, and you can start losing money. So yeah, so the spreads have a huge advantage over directional trades, and whenever you can profit if the stock is flat, up, or down as much as 10%, gives you a huge advantage over a directional trade.
So Jim asks, Chuck, what specifically is the reason the Kelter channel indicator works better than the Bollinger Band indicator? I don't know if that's true. I'm assuming it is because Jim asked it, but maybe you can speak to that, Chuck.
Yeah, that's a great question. They're both overbought, oversold indicators. I've used both indicators. I prefer the Keltner channels over the Bollinger Bands, but if the Bollinger Bands work for you, I'm all for it. But the important thing is they both will let you know if a stock is overbought. And of course, you don't want to buy the stock if it's overbought because it's likely to retrace. So wait for the stock to retrace towards that middle channel or the middle indicator in the Bollinger Bands, and you'll get a lower risk entry point, and the stock is more likely to rally once it's retraced, assuming it's still in a price uptrend and still trading above the 10-month simple moving average. So I would say both are good indicators. The important thing is you don't want to buy when the stock is overbought.
Now, this is a fascinating question. I think Natalie's still here, so if she can chime in, I'm going to ask her to. If she can, I apologize. But Jim asks, how can I do practice trading? And I'm going to take a shot at this, Chuck. And again, I don't know if there's a mock trading site or where you can do virtual trading on the site. But what I will tell you is it's a much different game when you have real money at work as opposed to just trading on, mock accounts or virtual accounts, that type of thing. The mindset is completely different. And I'm just telling you flat out, I think the rigor is elevated when your money is on the line. So I don't think you can replicate trading in a virtual way the same way you can do it in a real way. It's sort of like the speed of an NFL game. I don't think there's any way to prepare, not that I would know, but I don't think there's anywhere to prepare for that other than just playing the game. Natalie, I think I heard you, but do we have something that we can offer there?
No, just to piggyback on what you said, Guy, I think it's always smart for everyone to remember, it's a different game once you're trading with real money, as I'm sure Chuck would attest to as well. But I will say virtual trading platforms do give people who are new to trading entirely a good way to simply practice entering a trade, practicing different strategies, just the basics of how to, right? But you're right, it does not take into account the emotions, the real consequence of trading with real money. So that's always a good thing to keep in mind when you're practicing. And I'm sure Chuck would have some comments on that as well.
Yes, I think where the simulated trading really is helpful is if you're going to trade options, because it teaches you the mechanics of buying to open a call option, which means you're going long a call option, and then how do you exit that call option? You sell to close that call option. If you're going to trade spreads, you're going to buy to open a call option, and then sell to open a call option with a higher strike price. So I think those platforms, the simulated trading, are valuable just to teach you the mechanics of option trading.
Yeah, thank you, Natalie, and thank you, Chuck. That's a great answer. And this is what thing I've said over the years is I can teach trading mechanics as well as anybody. And I'll say that, it's not to be arrogant. I've just been doing it a long time. But you can't teach instinct, Chuck. And I think that's critical to understand. There's no way to teach instinct. And there's an old saying in sports, you can't teach height and you can't teach speed. Well, in our world, you can't teach instinct. So I think a lot of times you're either born with them or you're not. And it's a very difficult thing to learn. But to answer the question, I think it's a great way to learn mechanics, the paper trading, but it's not a great way to learn instinct. Chuck, is that accurate?
Yeah, I would agree with that, because there's nothing like having your money on the line. And you know, it can be very emotional, because you know, obviously the market's going up right now. You know, everybody's a genius because they're long, but you know, at some point that's going to turn around, and that's when you really have to stick to your discipline of creating hedges and protection for your profitable trades, because it's just a matter of time and the market's going to correct. And it's a question of whether you're going to accept a little less profit by creating that hedge, or if you're, you know, if you're going to have you know, expose yourself to big losses during a downturn. So of course, if you buy the at the money put option, then you're fully protected. If you have a really sharp downturn or a bear market, you're fully protected. That happened in March of last year, just when things really looked bad. You know, I had put options on my call options. I had put option hedges on my stock, and I mean, the velocity of that down move was just numbing last March. But I was fully protected. I had put options on everything. And the other interesting thing is, if you buy a call option and you buy a put option, if the stock really tanks, then that value, that put option is going to skyrocket, and you actually get a windfall profit, which I did last March on my option spreads, where I bought a call option and bought a put option. Those were actually windfall profits. I had 300, 400, 500% returns on those puts. So you can actually have windfall profits in a sharp correction, like we had last March.
Yeah, it's interesting. You know, that was talking about a period of time where the VIX, the volatility index, was sort of pegged anywhere from 13.5 to 15 for months. And then obviously, seemingly overnight, the VIX went north of 80. So you can you can do the math and you can understand how that would be the case. Listen, unfortunately, and I apologize, I tried to get to all the questions. I got a flurry of them late. I'm going to hand it over to you and Natalie to try to answer some of the other questions that popped up. I have to sort of go do my thing in a few minutes for Fast Money, so I apologize.
No problem, Guy. Yeah, I was just gonna.
No, I really
just gonna chime in actually.
No,
say thank you.
I enjoyed the conversation, Chuck. Again, you're a legend in the business. It was an honor to speak to you. I'm so humbled by the fact we had a huge audience. I think we really did well on the audience front, and that's a tribute to you, Chuck, as well. But I want to thank everybody that joined for their time. And I want to thank Natalie and Steve for theirs as well. Thank you, Chuck. I'm going to leave this to you. I'm going to sign off.
Thank you, Guy.
But I'll see you guys and gals again soon. Thank you.
Okay, great. Thank you, Guy.
Thank you, Guy.
Thanks, Guy.
Very
For
much.
everyone else, please be sure to stick around, because you know, even though Guy had to go, you can watch him later on CNBC Fast Money. But we're still here, and we still have a little bit of time left. But Chuck, I know you had mentioned you did want to share a little bit of additional details with our attendees about your products and what you have going on right now. I know we have kind of gone a little bit over our time, but if you still have time to do that, we'd love for you to be able to do so.
Okay, yeah. What I'll do, Natalie, is I have some slides here that I created on our Paratrend option system. And let me just make sure I have the, no, I don't have the right one. Let's see here. I want to share screen.
Yeah, we can see your screen. So if you just want to find the right slide, it should pop up.
Here it is.
Okay. While Chuck is finding that, everyone still with us. If we didn't get to all your questions, as Guy mentioned, you know, we apologize, and hopefully you'll be able to make use of the webinars at optionhotline.com email address to send us any questions, follow-up questions you might have. And at the end of the webinar, we're going to walk you through how to get in contact with Chuck's products or reach out to his team as well for any additional questions. So Chuck, we just see, I think it's a Word document. I don't
Okay.
see your PowerPoint now.
Okay.
So you might, I don't know if you're sharing the wrong screen or a different screen.
Okay. Let me see if I can get this one up.
Nope. No worries. If it doesn't work out, Chuck, we can always share our screen and show people how to access, optioneering in the power trend system while you just verbally talk about it. Oh, there you go.
Okay.
I see it.
There you go.
Oh, okay, good. Okay, good. So I wanted to show everybody how we select an option when we're going to trade an option, when we're going to take a long position. And we use the power trend. Let me go into slide mode here. Okay. So we use the power trend system to select options, and using the power trend system, I made over $3.7 million in closed out trades over the last 6 years. And we use technical analysis to select stocks. And if you can quantitatively measure the price movement of a stock using a trend following system, then you can determine the most likely future price movement of a stock. And what we use is the stock price in relation to the 10-month simple moving average. So we want to see the stock trading above the 10-month simple moving average. The most likely future price movement for a stock when it's trading above that 10-month simple moving average is up. And this can give us an advantage when we're trading. And then as we discussed, once you find a stock that's trading above the 10-month simple moving average, you want to look at the Keltner channels and make sure the stock is not overbought before you purchase a call option. So we simply wait until the stock retraces below the upper channel. So those are the two steps in selecting the stock. Now, once we select the stock, we use what we call the 1% rule to select the option strike price. And I'll just toggle through here to that 1% rule, just so everybody can see how we select an option strike price.
That sounds good. And while Chuck is looking for that slide, just a reminder, after he goes through the 1% rule and showing you the slides he wants to, we'll walk you through how to access, the actual page on the Option Hotline website to click through this and be able to get more information or even sign up if you're interested.
Okay, good. So option premiums consist of time value and intrinsic value, and options lose all time value at expiration and consist of only intrinsic value. So when you're buying an option, you're buying a decaying asset. And due to those time decay characteristics of options, when we buy an option, we want to minimize the time value, which is going to decay to zero, and maximize the intrinsic value. And the best way to do that is to buy an in-the-money option, which has more intrinsic value and less time value than at-the-money or out-of-the-money options. I think the biggest misconception in option trading is when people start out, they buy at the money or out of the money options because they're cheap and they're trying to hit a home run. But there's a lot of risk in buying at the money or out of the money options. So we developed a simple technique called the 1% rule for selecting an in the money strike option when we purchase an option. And the 1% rule simply limits the time value portion of an option to less than 1% of the stock price. And if you do that, you will minimize the time value, and which is going to decay to zero, and you'll maximize intrinsic value. So if you limit the time value portion of an option to less than 1% of the stock price, the stock only has to increase 1%, and you're going to start profiting on that option. And a 1% price increase to profit, that's going to have a much higher probability of being profitable than an at the money or out of the money strike price that can require a 5 to 10% or even greater price increase at option expiration to profit. Many times that expected price move will not occur before option expiration, and that can result in a 100% loss on your premium. So you want to try to avoid those 100% losers. So let's look at an example real quickly of the 1% rule. I did this with XHB, the home builders ETF. XHB was trading above the 10-month simple moving average. It had retraced below that upper Keltner channel, so it was no longer overbought. So I pulled up an option chain for XHB, and at the time, XHB was trading for 53.16. So we wanted to look at purchasing the 48 strike call. So you can normally select an option using the 1% rule if the strike price is about 8 to 10% below the current stock price. So you can start your search there for strike prices that satisfy that 1% rule. So with XHB trading at 53, 10% below that would be 48. So let's look at purchasing the 48 strike call. It had a 530 bid price, a 590 ask price. So when we trade options, we use limit orders. And in this case, we would enter an order. There's a 60-cent difference between the bid and ask. So we would split that and put the order in at 5.60, midway between the bid and ask. A lot of times you can get filled midway between. You may have to raise it another 5 or 10 cents in some cases to get filled. But let's just assume that we bought that 48 strike call option at 560. So we have call option purchase calculators that will calculate the profit potential for a trade, assuming various price changes in the underlying stock or ETF. In this example, from a flat stock price to an increase of 12.5%. So I plugged in XHB, trading at 53.16 at the time. The 48 strike, let's assume we bought that at 560, and click calculate. And what this will do is it will calculate that time value portion of the option. In this option, the time value is 44 cents. So we want to see that time value at less than 1% of the stock price. So with the stock trading at 53, 1% of 53 would be 53 cents. So this would satisfy the 1% rule. It's trading at 40, the time value is 44 cents. So this option would satisfy the 1% rule. And we can see that in this situation, if XHB goes up 44 cents, we're going to start profiting on this option. So if XHB is flat at option expiration, we're going to lose 7.9%. And just keep in mind, if you bought an at the money or out of the money call and the stock is flat at option expiration, that's 100% loss. So we'd much rather have a 7.9% loss than 100%. So let's look, if XHB goes up 1%, we will have a profit on the option. So that verifies that this option satisfies the 1% rule. We'll have a profit if the underlying stock only goes up 1% to 53.69. So there's no limit on the profit potential for a call option purchase. If the underlying stock continues to increase in price, then your profit potential keeps increasing. So in this example, if XHB is up 5%, we'd have a 39% return. If XHB is up 10%, we'd have an 87% return. So in this example, 10% price increase in the underlying ETF results in an 87% return for the 48 strike call option. So this option is giving us 8 times more profit potential compared to purchasing the ETF. So we like to use the 1% rule to select that strike price, and that will result in a higher percentage of winning trades compared to trading at the money or out of the money strike calls. And this higher accuracy can give you that discipline you need to be a successful trader. So I'll just go through my brokerage account statements here. This is on the power trend option strategy. I had over 3.7 million closed trade profits, average return of 169%. Obviously, I trade large accounts, and I trade multiple contracts, as many as 100 or 200 contracts. So if you're just trading one contract, obviously you can do that in a smaller account. So over the last 6 years, I had 187 winning trades, 18 losing trades. So it was 91% accurate, and a large part of that accuracy was due to using that 1% rule to select the option. So in applied materials, I had $42,000 profit. In Amazon, $162,000. So these are closed out trades over the last 6 years. Boeing Aircraft, $205,000 profit. Alibaba, $81,000. The BRIC ETF, 156. EEM, 292. CBOE, 104. FDN, that's the Internet Index, 188. Home Depot, 128. ITB, the Home Builders ETF 55. UDOW, the leveraged Dow, 358,000. KWEB, the Chinese Internet ETF, 314,000. Apple, 364. The FAS, leveraged financial, 407,000. And for the triple Qs, 590,000. So this power trend system has been working out well for us and continues to profit during the current market conditions. And as I mentioned earlier with Guy, though, whenever we have a profit in an option purchase, we'll leg into a spread trade to help protect those profits. So that's something we can look at in a future presentation. We'll look at option spreads.
That sounds great, Chuck, and thank you. I know you had to skip, like 100 slides in order to focus on that 1% rule and get there, just because we had such a great conversation between you and Guy. And I'm happy that we were able to focus on that, the meat and potatoes, which is fantastic. Hopefully you all can see the screen I pulled up here. It's Chuck's main screen on the About tab on Option Hotline. You can read a little bit more about him, but I just want to draw your attention. If you click on his image here, you'll be able to go to his optioneering page, which he just detailed one product within the whole system. He just talked to you all about that. So if you want to get more information, you can just click this button here, Learn More at TradeWinds, and it takes you over to that page, and it'll give you all the information. You'll have an opportunity to sign up if you choose. So we encourage you to visit that page and go ahead and do that. And I did want to remind everyone today that aside from Chuck talking constantly for the past hour and giving, so many details and answering as many questions as possible, which has just been amazing, he's also giving everyone attending today a free giveaway, a copy of his ebook, Options Trading Made Easy. So, we thank you for that, Chuck, and we thank everyone here who attended. Steve, I know you're still here. If you want to, I'm going to go ahead and just show everyone one last time how to get in contact with us. If you want to verbally let them know where to reach out and where to expect an email from.
Sure, very good. This is our contact page once again. If you have questions about any of our webinars or podcasts, please email us at webinars@optionhotline.com. If you have any questions that are more general and for customer support, please email us at support@optionhotline.com. If you have any kind of general sales questions about some of our products, some of Chuck's products, you can email to info@optionhotline.com.
Thank you, Steve. And one last reminder, you're all going to be getting an email tomorrow from webinars@optionhotline.com. That's going to have the recorded replay of this afternoon's webinar, as well as information about the free giveaway. So please be sure to mark that on your accepted senders list and keep an eye on that and, watch the spam traps. Chuck, thank you so much.
Yes, thank you, Natalie, and thank you, Steve, for
Thank you,
putting
Chuck.
on this educational webinar. I enjoy doing these, and I actually learn a lot doing these webinars because I'll get questions that I don't know the answer to, and then I'll research it after the webinar, and I really learn a lot doing that. That's how I found out about the Keltner channels, was a question during a webinar. So I enjoy doing these, and
Oh, wow.
we all appreciate you putting this on today.
Well, and Chuck,
Thank you so much, Chuck.
you should be complimented. We still, as of right now, have well over 100 participants
Awesome.
still on with us. So you are a big draw, and almost all of our participants stayed with you. And for those of you who were not on, we are going to do another quick tour of the website. Chuck, anything else that you would like to add at this moment?
No, that's it. I want everybody to have a great day, and good luck in your trading going forward.
Very good. Thank you again, Chuck. Enjoy those mountains out your way.
Okay, will do.
And
Thanks, Chuck. We'll talk with you soon.
thanks
Okay, great.
again.
Thanks, Natalie. Thanks, Steve. Have a good day, everybody.
You bet.
Bye-bye.
And
Bye-bye.
Natalie, anything you want to add before I go quickly into one last spin through the tour?
No, sir. I can see your screen. Go right ahead.
Okay, very good. This will be very short, but we do actually have still just under 100 participants. So hopefully you will enjoy this very quick tour of the website. We're on the contact tab, so I'll just stay here. And basically, if you would like to contact us at Option Hotline, there are a lot of ways that you can contact us. Let me I'm sorry, I wasn't technically on that, so now I'm on it. We are here when you need us, and we did go through this, but I'll go through it once again very quickly. If you have any questions about our podcasts or webinars, please email us at webinars@optionhotline. If you have any general questions for our customer support line, they are very good and get back to you very quickly and frequently. So support@optionhotline.com. Any sales questions that you might have as you're looking through some of the products that we have, some of the subscriptions, please feel free to email to info@optionhotline.com. And same thing as before, if you're having any difficulty receiving any of our emails, if you check your spam folder and you see one in there from us, please take a look at this this whitelisting of Option Hotline emails. And also, as long as you're there, you might want to download the Option Hotline contact card. And once again, our editors love hearing from you. You can either email them directly at any of these email addresses, or you can send us a general email down here at the bottom of this contact page with your name, your email address, and your message, and we will get back to you. We will definitely get back to you. Quickly onto the webinars tab. We just had this great webinar from Guy and Chuck, and it will be up there tomorrow, the replay under our featured webinars. was today, and it will be under the webinar replay as of tomorrow. And as Natalie mentioned, you'll get an email identifying that and identifying a link to the recording of this email. You'll also see our at least one next upcoming email. Sometimes we have 2 of them in there. Sometimes we even have 3 of them in there, but our next webinar is 1 week from today with Dr. Duke Gibbon, and we certainly invite all of you to join us for that. Lastly, I do want to go to the About tab. And this will tell you just a little bit more about Option Hotline. Many of you are probably familiar with the site itself, but you may not have gone through this tab or every single tab. We do have a mission statement and a value statement. Encourage you to read those at your leisure. Also, we have a bio and blogs from a blog from each of our Option Hotline editors, commentators, and so we invite you to check out all of those. And this is quite a savvy group. They are seen on television, they're seen on the internet, they're seen around the world. Quite an exclusive and high-level group. You see Chuck's picture here, who just gave us that great webinar. And so we invite you to check out their bios and their blogs. And as we before, you do have any information to contact them directly. So without further ado, that will end the tour. And Natalie, anything I missed or anything you'd like to add?
No, I think you're great, Steve. Just want to thank everyone today who joined us, and we look forward to having you all at a future webinar. Check that webinars page in your inboxes, and we'll see you all soon.
Great, and check your inboxes tomorrow. And that will conclude our webinar. So thank you all very much. We appreciate you coming.